Good morning, everybody, and thank you for joining me. I'm Daniel De Lange, and I'm going to take you through Microsoft's second quarter results. Just a quick overview of what I'm going to be speaking about today. I think most people are familiar with Microsoft, but we'll take a look at what they do. Then we'll waste no time, we'll jump straight to the recommendation. We'll take a look at the second quarter financial results, and we'll look into more detail into each division. Then we'll take a look at the company's guidance for the year, and we'll finish off with portfolio guidance. So first of all, what does Microsoft do? Who are they? It's an American multinational technology company. Microsoft develops, manufactures, licenses, supports, and sells computer software, consumer electronics, and personal computers and services. Its best known software products are the Microsoft Windows line of operating systems, as well as the Microsoft Office suite, which is most people are probably using at the moment, and the Internet Explorer, as well as Edge web browsers. Okay, so we'll jump straight to the recommendation. Although the share is trading at a forward PE multiple that is ahead of its long-term average, we believe that the expectations for accelerated growth are fairly reflected in the share price. Revenue should show growth in the medium term, given the successful transition of the business to the cloud offerings. And part of Microsoft's success comes from its competitive advantage to leverage its existing commercial relationships in the group's large installed base of Windows and Office products. Cloud momentum should offset the secular decline in the traditional PC revenues from the substitution of mobile devices. Cloud also increases the annuity income profile for the business, and the cloud revenue will also be supported by the newer Azure Stack offering. This is a hybrid cloud system which will help onboard additional cloud clients which already have their own data center infrastructure. The negative margin impact of a bigger contribution from lower margin Azure revenue should be offset by higher margins in the more personal computing segment, as well as improved Azure margins from capacity utilization and growth in Azure's premium services. Now we'll take a look at the second quarter financials. Firstly, their revenue was up by 12% to $53.5 billion. This was driven by cloud offerings, Azure, and 365 products, as well as the full period inclusion of LinkedIn, which contributed to $2.5 billion from the $228 million in 2017. Microsoft acquired LinkedIn at the end of the second quarter of 2017. The gross margin improved to 63.8%, up from 62.8%, and this was driven by a more favorable revenue mix and a higher margin in the more personal computing segment. Next, the adjusted operating profit came in at $16.4 billion. That's in line with a revenue of 7%, a 12% increase, and then a marginally higher operating margin of 30.7%. Where in 2017 it was 30.6%. Higher expenses reflect the acquisition of LinkedIn, investments in commercial sales capacity, and a higher R&D expenditure. The adjusted earnings per share came in 19% higher at 180 US cents, benefiting from a lower effective tax rate. But the earnings per share only came in at 44 US cents, and the difference is mainly due to once-off adjustments relating to the tax reform. Now we'll take a look into the divisions in more details. First, we have the productivity and business processes. Most of these products and services most people will be quite familiar with. It consists of products and services in productivity, communication, and information services, spanning a variety of devices and platforms. This segment primarily consists out of Office Commercial, which includes the Office 365 subscriptions, and it includes Office Exchange and SharePoint, as well as Skype for Business. Then Office for the Consumer also includes Office 365, and it includes products and services like Skype, Outlook, as well as OneDrive, and then obviously LinkedIn, which was acquired towards the second quarter of 2017, like I mentioned earlier. Next, we have the Intelligent Cloud division. This division consists of public, private, and hybrid server products and cloud services. And this segment mainly consists out of Microsoft SQL Server, the Windows Server, Visual Studio, System Center, and then as well as Microsoft Azure. Then finally, we have the third division, which is the more personal computing division. This segment consists of products and services which is geared towards harmonizing the interests of end users, developers, as well as IT professionals across all devices. And this segment consists out of Windows, including Windows original equipment manufacturer licensing and other non-volume licensing of the Windows operating system. This division also includes devices such as the Microsoft Surface PC accessories, and then also other PC accessories and other intelligent devices. And then also a big one here is the includes gaming, the big Xbox, and it includes the Xbox hardware and software as well as services. Next, this chart just shows you how each division contributed to revenue and operating profit. The outer circle represents how much each division contributed to revenue, and then the inner one to operating profit. So first of all, you can see there productivity and business processes contributing 32% to revenue, and then 39% to operating profit. Intelligent Cloud 28% to revenue, 30% to operating profit, and then the more personal computing division contributing the most to revenue, 40%, and then 31% to operating profit. So each division contributing a lot to the revenue and operating profit. But first of all, we'll take a look at productivity and business processes. Their revenue was up by 26%, reflecting the contribution of LinkedIn, although both Office and Dynamics still grew strongly. The operating margin, however, fell to 36.9% from 43.8%, and this is mainly due to LinkedIn's operating expenses, as well as investments in cloud, investment in sales capacity, and then also the impact of a legal benefit in the previous period. Next, we get to Intelligent Cloud. Their revenue came in 14% higher on the back of Azure, which nearly doubled its contribution, while Enterprise Services revenue edged 3% higher. Their operating margin improved to 33.8% and a contained operating expenditure, which was offset by gross margin pressures from the growing contribution of the cloud business. Okay. Then next we get the more personal computing division. Their revenue was relatively flat, only saw 1% growth, and this was driven by higher Surface sales, gaming, Windows, and search sales, which offset a decline in mobile devices. In the commercial PC market, Windows gained share, while the operating system underperformed in the consumer PC market. So all these factors contributing to a relatively flat growth in revenue. Then you get the operating margin. This expanded by 200 basis points to 23.6%. This was driven by higher gross margins through a more favorable sales mix and higher device margins. Okay, so now we get to the company's guidance. First, we'll take a look at the third quarter guidance. Management said that they expect exchange rate impact will increase revenue by 2%, cost of sales by 1%, and then operating expenses by 1%. They expect that the productivity and business processes divisions, that their revenue will be between $8.6 and $8.8 billion, which is an increase of between 8% and 11%. If you look at it on a year-on-year basis, then they expect Intelligent Cloud revenue to be between $7.55 and $7.75 billion, which is an increase of 12% and 15%. And then their more personal computing revenue is expected to be between $9.1 and $9.4 billion, which is an increase of 3 and 6% year on year. They also provided then guidance for the full year for the financial year 2018. They expect stable gross margins compared to the 1% decline previously, and then they expect The operating margin slightly ahead of the previous year, including LinkedIn, and more than 1% increase in the operating margin if excluding LinkedIn. They expect the effective rate to be around 16% for 2018 and slightly below the statutory rate of 21% in 2019. So finally, we get to the portfolio guidance. This is a very good quality business with high operating margins. It has high ROE, strong cash generation, and also has a high proportion of earnings coming from annuity income streams. We do, however, believe that the share is fairly valued at current levels, and we would recommend portfolio exposure of 0%. So just before we end off, please take note of the following disclaimer, and if you wish to place a trade, please contact the trading desk. And also, if you have any questions, you can type it into the chat box now, and we'll get back to you via email. Thank you so much for joining me today. I hope you have a great day, and thank you very much.